Hi everyone, today I'm going to analyze Zendesk. It's an exciting new company in my opinion at least. It is a CRM company which stands for Customer Relationship Management, which is basically a company their product is software that's going to help a company, as I like to say, to manage their relationships with customers. So to put that in other words, basically just provide better customer service all around the organization. You have everyone in the organization connected through the software where one person inputs data, everyone has access to it. It's supposed to increase customer service and differentiate the service for each customer to make it the best for that specific customer. So let's get to the numbers now. So net income has been negative for the past 3 years. So is earnings before tax. So that is why, even though this is labeled net income, which is what I like to use because it's the most conservative and accounting based, I just substituted the free cash flow this time. So disregard it saying net income right there. I just don't. I just want to keep it as net income because that's the way I usually model. But I put a note in there just to remind anyone looking at this and to remind myself. So the highest growth rate for the CAGRs in the past 3 years was operating cash flow, which is actually pretty rare for a newer company. The EBT, or earnings before tax, is calculated as positive, but really, as you can see over here, the earnings before tax has actually been shrinking the past 3 years. It's just the way the math turns out. So disregard the earnings before tax. So besides that, the lowest is revenue, which should be the highest for a new company in my opinion because everything comes from that. So, yeah, I mean it's still a good growth rate though. So I'm okay with those. Look great. Besides, obviously disregard net income as well because I'd substituted the free cash flow into that. So that's why net income and free cash flow are the same number. So if I did do net income, it'd be the same exact thing as that since there was no tax benefit to this company. So let's go on to the next part of my perpetual growth rate. Pick 2% just to help increase the uncertainty of this newer company. And optimistic, they've proven to me in the past 3 years that they can grow at a rather high rate, well above average. So I don't see it being possible to go past 60%. That's very optimistic, which is what I go for with that number. To be very pessimistic, I did a 15%. Now, normally I apply these numbers to the net income, but like I mentioned earlier, we're doing free cash flow for this one just because the net income was negative. So this is assuming 60% growth in free cash flow for the next 10 years, or in a bad situation, 15% for the next 10 years, compounded annual growth rate. So down to the next section, I promise I can talk. I have my discount rate. This is constant for me, basically 12%. Average return of the S&P 500 after dividends are reinvested. Anything I can get above that's fine with me, really. So let's see. Let's go down past all these numbers down to using that optimistic growth rate. I got to possibly valuing this company all the way up to $204.38. Using that pessimistic, though, goes all the way down to $10.69. Big range, not very specific, but that's why valuing is difficult. It's more of an art than a science, and the market value right now, as you probably saw, was $139.45. Now that's comfortably in between those two numbers. However, I'm still 60% is really optimistic, but it's possible if they could get any type of competitive advantage, which we'll discuss here later in the video. So next section, I can't say that today. Next section, I got to practice that more, is the financial ratios or what I call just financial health. Amazing current ratio since they don't have any inventory. Quick ratio is the same thing. tangible book value per share, pretty low compared to the price, but another good thing, though, is the intangible and goodwill to total assets is 10%, so it could be worse. But to go back to the one I just skipped, debt to equity, that's pretty high even for a newer company. That's almost twice as much debt as you have equity, but they've got the growth and free cash flow to support that, so I'm okay with it. And yeah, I mean, they have very little intangible assets, so I mean, it looks good when it comes. The balance sheet looks decent, but the total equity is going to technically go down every year as long as we're still having net income, unless we sell more shares, which is not a good sign for the business. So yeah, I mean, I'm kind of neutral on the financial health. Good current ratio, but can we sustain that is the question in the future. Now, the projection. Now, the reason I've also been more conservative about my projection is looking so far at this year in 2020, the first 3 quarters have been terrible for this company. We haven't had positive free cash flow yet. One quarter we even had negative $70 million of free cash flow. Revenue is growing. It's expected to be I have it as $1.1 billion compared to $816 million last year. But for everything else, earnings before taxes not looking good. Net income's looking negative again to me. Operating cash flow for the first time is looking negative to me. CapEx has been high this year compared to average as well. Like one quarter we've already surpassed one full year in 2017, which is not uncommon for a growing company, but still it's not a good sign when we're not making a positive free cash flow. Now, just to authenticate the information here, we do have an unqualified opinion, and I always add that just to, just in case some of these newer companies, a lot of times I'm always on the lookout for, anything in that auditor's report that says we're worried about so-and-so. So this one actually looks good, which makes sense because the numbers are pretty bad in the recent quarters. But this is another thing I wanted to show. I don't usually put in here, but this is the competition statement. And when you look at the competition that they're worried about, it's pretty scary. You've got Salesforce, you got Oracle, you got Microsoft, and ServiceNow. So, and they say even with smaller companies, we have pen and paper, which I thought was getting a little too detailed. But text editors, spreadsheets, just basic computer tools. And then large companies were competing with the mega tech companies. So when it comes to competitive advantage, I don't see one with this company. It's basically just an alternative to Salesforce. If someone had ever had a bad taste in their mouth about Salesforce, they could hop over to Zendesk. Then again, I haven't used Zendesk. I have used Salesforce, but from what I've read about Zendesk, it's basically the same thing. And like they say in their competition statement, excuse me, like they said in their competition statement, those other companies have more money and can be more adaptable. So I actually don't recommend buying this company right now just because of the recent 3 quarters are pretty bad. And I don't see them having a competitive advantage, so I don't see them turning it around. I could be wrong, though. Let me know if you disagree. Also, please subscribe. Almost all of my views are coming from non-subscribers, so I'm trying to change that. And I am also trying to create more content on a regular basis so I can provide value for my subscribers. So please hit that subscribe button if you haven't already. Thank you.